Welcome to The Explainer. Today, we're jumping right into an in-depth, completely objective look at a literal giant in the healthcare space, McKesson Corporation. If you follow this sector, you already know they're one of the dominant Big Three U.S. pharmaceutical wholesalers. But today, we're unpacking exactly how their latest financial and strategic moves are shaping the whole future of healthcare distribution in 2026.
Okay, let's quickly lay out our roadmap. We're going to cover 1. The healthcare distribution giant, 2. Q1 financial performance drivers, 3. A strategic $2.25 billion acquisition, 4. The Wall Street valuation debate, and finally, 5. Investment risks and challenges.
Starting right off with Section 1, the healthcare distribution giant. To really get a read on McKesson's playbook, we first need to appreciate the sheer scale of their footprint across North America.
$105.5 billion. That is their market cap as of August 2026. Absolutely massive, right? Alongside Cencora and Cardinal Health, McKesson makes up the Big Three pharmaceutical wholesalers. And get this, together those three control over 90% of the U.S. pharmaceutical wholesale market. They are, quite literally, the essential plumbing of the healthcare system. So tracking their maneuvers isn't just about analyzing a single stock, it's about seeing where the entire medical supply chain is actually heading. So, how is a beast like this actually structured? Well, it basically boils down to 4 main operating segments. First up, you've got North American Pharmaceutical, which is their largest segment, handling everything from branded to generic and specialty drugs. Then there's Oncology and Multispecialty. You're definitely going to want to keep a close eye on this one because it's a massive, fast-growing engine for them right now. Third is Prescription Technology Solutions, which is all about access and logistics. And finally, Medical Surgical Solutions. Now hold that thought on Medical Surgical because they're actually prepping that one for a major spinoff.
Moving right along to Section 2, Q1 Financial Performance Drivers. Let's look at their August 5th earnings report to see how all those operating segments are actually cashing in. And check this out. For the first quarter of fiscal year 2027, McKesson delivered adjusted earnings per share of $9.93. They easily cleared the consensus estimate of $9.44, representing a 20% jump year over year. On top of that, total revenue spiked 8% to hit a staggering $105.38 billion, and that's just for a single quarter.
But you're probably wondering, where is all that volume coming from? Well, $15 billion. That one number represents McKesson's distribution revenues for GLP-1 medications alone in Q1. It is a jaw-dropping figure that surged 24% year over year. It just perfectly showcases the immense impact these weight loss and diabetes drugs are having on distribution channels today, and how heavily they're padding top-line growth. Because of that massive Q1, and specifically a crazy 41% operating profit spike in that oncology segment we mentioned, management is feeling pretty confident. They actually raised their fiscal 2027 adjusted EPS guidance to a range of $44.20 to $45.60, which implies a really robust 13 to 15% growth for the year.
So, what are they going to do with all that cash flowing in? That brings us to Section 3, a strategic $2.25 billion acquisition. Let's look at how McKesson is aggressively shuffling its deck for future growth.
If you look at this timeline, they are certainly not sitting still. In June 2026, they sold a 13% stake in their medical surgical unit to Apollo Global Management for $1.25 billion. They're prepping it for a January 2027 spinoff as a completely standalone public company called Wellverse. Now, at the exact same time they are shedding that unit, they announced a definitive agreement in August to acquire Precision Medicine Group for $2.25 billion. Basically, they're actively trading out of medical surgical supplies and going all in on oncology and specialized research.
Okay, so what exactly does $2.25 billion buy you? Precision Medicine Group brings a ton to the table. Biomarker intelligence, lab services, global clinical research organization or CRO capabilities, plus market access and commercialization support. Let's strip away the corporate jargon for a second. This acquisition is an absolute game changer because it lets McKesson engage with biopharma clients way earlier in the drug development cycle, seriously supercharging their already booming oncology platform. And the financial logic here? It's crystal clear. $63.7 billion. That is the estimated value of the global healthcare CRO market for 2026 alone. Plus, it's expected to grow at a 7.5% annual rate through 2033. By rolling Precision Medicine Group into its Oncology and Multispecialty segment, McKesson is basically buying direct exposure to a highly lucrative, high-growth space. All right, so how is Wall Street digesting all of this? Let's get into Section 4, the Wall Street valuation debate, and see how analysts are pricing in these power moves.
Looking at the Analyst Consensus, you'll see a lot of optimism. Across 18 analysts polled, McKesson holds a solid buy rating with an average price target of $986.94, which implies about a 10% upside from current levels. You've got firms like UBS aiming as high as $1,080. But to keep things totally objective here, we have to note the contrarians too. RBC Capital, for example, initiated coverage with a hold rating and a much more conservative price target of $845.
And that brings us to the core debate right now, valuation. McKesson is currently trading at roughly 18.4 times forward earnings. As you can see, that sits well above its 5-year median of 15.7 and above the industry average of 17.6. Some valuation models, like the GF Value Indicator, even suggest the stock is about 5.9% overvalued. So you're definitely paying a premium for that impressive growth. The real question for investors is whether that premium is justified by these strategic pivots.
Which leads us right into our final section. Section 5, Investment Risks and Challenges. Because to make a truly informed assessment, we have to look at the flip side of the coin and detail the specific hurdles they're facing.
First up, and arguably the most glaring risk, is customer concentration. Take a look at this. A whopping 73% of McKesson's fiscal 2026 revenues are tied to just 10 massive customers. In fact, their largest single customer alone accounts for 24% of their total revenue. That heavy concentration makes them incredibly sensitive to contract renewals or any sudden shifts in purchasing behavior from those key partners.
Beyond that concentration, there are a few other headwinds to keep on your radar. You've got ongoing policy and regulatory risks, think potential drug pricing reforms and changes to the 340B program. There's also the undeniably complex execution of spinning off that Wellverse unit next year. Also, it's worth noting they posted a negative free cash flow of $372 million in Q1. Now, management did clarify this was just due to working capital timing, and they still expect up to $4.9 billion in free cash flow for the full year. Still, when you're trading at a premium valuation, any execution misstep is heavily magnified.
So it's a real balancing act. On the bull side, you've got explosive GLP-1 and oncology growth, massive capital returns, including $2.5 billion in Q1 buybacks and a 15% dividend hike, plus that highly strategic CRO expansion. On the bear side, you're looking at a historically high 18.4 forward PE, that heavy customer concentration, and ongoing policy uncertainty that leaves a razor-thin margin for error. It really all boils down to this quote from a recent NASDAQ analysis. They noted that the current setup, quote, favors patience over chasing the shares after a strong re-rating. There is no doubt McKesson's operational engines are firing on all cylinders, completely reshaping the future of pharmaceutical distribution. But we'll leave you with this final thought to chew on. Does McKesson's aggressive, specialized growth strategy truly justify paying Wall Street's premium price tag today? Thanks for tuning in.